All right, welcome to Who Charted. This is the final episode of the year. With me today is Drew Wells, our research associate, following up on his stellar debut performance from 2 weeks ago, which garnered the most views in the history of this show. So we're going to look to make it 2 in a row here. Happy to have Drew with me. Drew, let's get after it. You know the rules. 6 charts in 6 minutes. Let's go.
That's right. Here we go. So I think if there's one chart that describes this market environment that we're in right now very well, it's momentum, right? So this is the Dow Jones High Momentum Index. This is a upward trend. It's probably one of the most busted ugly trends that you'll see so far this year. Unfortunately, right now, for momentum, it is trapped between a 50 and a 200-day moving average right below that resistance level right around 3,400. So let's move on to something that might be a little bit prettier. In that bottom pane right there, what you'll see is momentum relative to the U.S. equity market, right? So one of the things that I think is really interesting about this chart is that we're touching those summer lows back in July on a relative basis. And if momentum is going to start to outperform, it makes sense that that would happen somewhere around here. We don't want to jump the gun and get too excited and make any big, bold calls just yet, because that could obviously go the other way as well. But underneath the surface on a relative basis, if we get some improvement here, that could be a big win for momentum.
All right. Title of this week's show is New Highs Are Bullish. But, you know, obviously that makes sense if you're looking at the S&P 500, if you're looking at the NASDAQ, but our job is to drill down under the surface. So what I did was pretty simple. I did a quick scan of some of the sub-industry groups within the S&P 500 for groups that are making 63 and 126-day highs. For those of you playing along at home, those are 3 months and 6-month highs. First group that jumps out at me is Construction Materials Index, new closing high last week. And on the verge of a relative breakout. So on an absolute basis, we have price trending above the 50-day moving average, which is in line with support at the breakout level. But more importantly, what we love to pay attention to is that relative strength relative to the S&P 500. Nice near-term uptrend above a rising 50-day moving average and on the cusp of taking out those May highs. So we're looking for that to really kind of solidify leadership here for the Construction Material Index. Not there yet, but on the radar screen.
All right, another breadth chart, right? I know some of you all are rolling your eyes already, but let's take a look at the equal weighted NASDAQ 100 versus the NASDAQ 100, right? So breadth has been a problem, here recently, particularly within the NASDAQ. But one thing that I want to point out is that might begin to start improving. And if you look at the bottom pane here, this is percentage distance from the ratio and its 50-day moving average. If we go back and look at that throughout time and look at the whole data set, we're now -3 standard deviations below that. We just hit that actually in the beginning of December. That's traditionally a very oversold metric. So sometimes what you'll see is whenever you hit these very extreme oversold levels, you'll get a little bit of a bounce in a relative basis. So I think it's safe to say that we could expect to see possibly some improvement in breadth, at least in the near term in NASDAQ. That doesn't mean that it'll necessarily change that downtrend that's been happening all year throughout 2021. But if we're going to see breadth improve, it makes sense to probably see that happen somewhere around here.
All right, another group that traded to new 3-month, 6-month highs last week, actually closed at those levels. Healthcare providers and services. Now, I touched on this in one of our daily notes that we publish. A very similar setup here, above a rising 50-day moving average, above the breakout level, coming out of a consolidation relative to the S&P 500. And what's interesting to me here is that we're not very stretched. We looked at the 50-day Z-score of this group relative to its 50-day moving average, and we're not quite at 2 standard deviations yet. Now, a lot of people like to just kind of blindly buy new highs. I think it's important to go out there and get a sense for where is that new high taking place relative to some measure of trend. In this case, we're using the 50-day moving average as we often do. And, you don't want to buy something that's super extended from its 50-day moving average just because it's making a new 6-month high or just because it's making a new 3-month high. We like to kind of drill down, do a little bit of extra work there. And I want you to contrast this chart with the one I'm going to show later. But right now, this is a compelling looking entry point for that group.
All right, the commodity super cycle that never was, or is maybe yet to come. So this is a chart of the CRB index relative to the S&P 1500. This is a very broad-based, two very broad-based metrics that we look at. So again, one of the things that you'll notice is this ratio is trapped below a 50 and a 200-day moving average, below a major resistance area there, area of polarity. On top of that, it's stuck within this, on the bottom pane right there, it's stuck within this bearish regime of momentum. And with all of that being said, I'm going to talk out of two sides of my mouth here for just a minute. We do have higher lows and some higher highs in this ratio over this time frame. So again, this is a very ugly trend within risk assets. If we see a breakout above that highlighted area, if we see momentum break out into a bullish regime and clear some of those moving averages, I think we can start to get a little bit more constructive on commodities on a relative basis relative to equities here. But again, another chop and slop trend.
All right, here's another group that we've been talking about. As a matter of fact, if you go back to one of the episodes of this show that we did in July, we pitched this group, hardware and storage. At the time, we were discussing how everybody was hopped up on software. And when I said, that software has to run on hardware. That was the pitch at the time. Continues to play out. New highs last week, 63 and 126-day basis, but look at how extended this is. This group is about 3 standard deviations above its 50-day moving average, and this is what I'm talking about. Now, we do have a nice relative trend above its 50-day. We're breaking out above those early 2021 highs, but in terms of absolute price, this is what it means to be extended above the moving average. So yes, we do have a breakout. Yes, we do have new highs, but might be a higher risk entry here relative to the other two groups that we were looking at earlier today. So I just wanted to kind of clear that up and contrast those two differences. Don't just blindly go out and do things just because there's a new high. Do the extra work. That's what we've done here.
All right, everybody. Thanks so much for spending some time with us. If you found this information helpful, please consider sharing this, liking, and subscribing. And we look forward to seeing you in the next video.
All right, everyone. Thanks again. Have a great holiday. We'll see you next year.